You think you can catch up on your missed sales tax filings whenever, but every day you wait makes it more expensive. Catching up is actually one of the more manageable fixes in sales tax compliance, but the real risk is rushing it when you're behind. We help sellers through this every week, and today I'll walk you through getting caught up and where you really need to slow down. There are actually two different situations sellers find themselves in when filings are missing. The first is what I'm about to break down. You're already registered with a state, you have a filing portal, and you can see which returns are past due. The path forward is clear, even if it's not fun. The second situation is sellers who have never registered at all. They have Nexus in a state, they know they should have been filing, but there's no account, no portal, nothing. That situation involves a different process entirely, and we're covering that in a separate video, which I'll link in the video description below. So if you're in that second bucket, check out that link. If you're already registered and just need to catch up, let's get to it. Businesses miss filings for all kinds of reasons. Filing frequency change notice that slipped below the radar. Somebody got busy and the deadline passed. A staff change left nobody actually responsible for getting it done. Or, in some cases, a seller registered in a state without fully understanding that registration comes with an ongoing obligation to file, even in periods with no sales. Whatever the reason, it doesn't change the path forward. The core of catching up is straightforward. Log into the state's filing portal and file the returns that show as past due. Where it gets more nuanced is how complicated that actually is to do, and that varies significantly by state. Some states are genuinely simple to file. Indiana is a good example of this. Indiana has a flat 7% sales tax rate with no local additions and no jurisdictional level reporting required. The return asks for gross sales into the state, and the math is straightforward. For a state like that, a seller with organized sales data may be able to work through the missing returns without much difficulty. Other states are a different story. California, Washington, Kansas, and a number of others require sellers to break out sales at the jurisdictional level, meaning the return wants to know not just total sales into the state, but how those sales are distributed across counties, cities, and districts. For those states, the data requirements are more demanding, and the margin for error is higher. A useful way to gauge what's ahead is to log into the state portal, click through as though you're about to file a return. When the form where the sales data gets entered comes up, it becomes immediately clear whether it's asking for a simple statewide total or a detailed jurisdictional breakdown. That will tell a lot about what the catch-up process is going to look like. But this next part is worth saying clearly. Filing incorrectly and then needing to amend those returns is more expensive than taking the time to correctly file the first time. When a return is amended, it doesn't freeze interest at the original filing date. Interest continues to accrue while the corrected return is being processed, which means the cost of getting it wrong compounds. For sellers with meaningful liability across multiple periods, that difference can be significant. The general recommendation here is always to consult with a sales tax professional before filing catch-up returns, especially in complex states or where the liability amount is substantial. For simpler states with lower liability, the risk calculation may be different. But the higher the dollar amount and the more complex the state, the more valuable it is to have someone who knows the filing format handle it correctly from the start. On the topic of what's owed, past due returns will come with penalties and interest on top of the original tax liability. One thing worth knowing is that payment timing can be a little nuanced. Some states need to formally assess the penalty and interest amount before it can be paid. In those cases, filing the return and paying the tax comes first, and the P&I bill follows separately. On the question of penalty waivers, some states do have a process for requesting that penalties be reduced or waived if there is a reasonable cause for the missed filings. During COVID, states were broadly lenient about this. That leniency has largely gone away, and penalty waivers are less common now than they were a few years ago. That said, the process exists in a number of states, and for situations involving significant penalty amounts, it's worth asking, particularly if there's a legitimate reason for the missed filings. It doesn't hurt to ask. In some cases, it does make a real difference. But what happens when you owe tax that you never collected? Well, for more on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.